All right, everyone, welcome. In our lecture today, we're going to shift from some of the core theories we've been discussing to a very, very practical application, the disposal of accounts receivable. Now, this is a topic where financial reporting and smart business strategy really come together. We're going to look at how a simple line item on the balance sheet can be used as a powerful tool to manage a company's absolute lifeblood, its cash flow. Getting a handle on this is fundamental if you want to understand how real businesses navigate that tricky gap between being profitable and actually having cash in the bank.
So, let's kick things off with a scenario, a paradox, really, that trips up a lot of businesses. Imagine a company. They've got a great product, sales are through the roof. You look at their income statement, and it shows fantastic revenue and a healthy net income. By all accounting measures, this company's profitable. But then payroll is due, the rent needs to be paid, they have to pay their suppliers, and when they look in the bank account, it's empty. This isn't just a textbook hypothetical. This situation, being profitable on paper but having no cash, is a massive and very real challenge in the world of corporate finance.
So where does this problem come from? Well, it all goes back to an asset account you all know well from the balance sheet, accounts receivable. You know, these are basically the IOUs from your customers. It's the money they owe you for the products or services you've already delivered. And yes, it's correctly listed as a current asset because you expect to get that cash within a year. But here's the kicker, and this is the point you really need to get. It represents future cash. Those receivables have value for sure, but they aren't liquid. You can't spend an IOU to pay your employees.
So this dangerous situation, it has a name. It's called a liquidity crisis, or more commonly, a cash flow crunch. And it is one of the top reasons why so many otherwise successful, profitable, and fast-growing companies actually go bankrupt. It's shocking, right? A company can be making tons of profit and still fail. This really drills home a key rule in finance. Profitability is not the same as solvency. It's liquidity, having the actual cash to pay your short-term bills, that keeps the lights on day to day. For you, as future business leaders, knowing how to manage this gap is an absolutely essential skill for survival. So let's explore how companies do just that.
Okay, so that's the problem. The big question for any manager is, what do we do? You're sitting on a pile of these valuable IOUs, this accounts receivable, but you've got payroll due on Friday. How do you turn that paper into cold, hard cash when you need it most?
The answer lies in a set of strategies we call the disposal of receivables. Now, I know disposal sounds a bit harsh, like you're throwing in the trash, but in accounting speak, it just means getting an asset off your books. In this case, it means you legally sell your claim on that future money to someone else, and in return, you get what you need, cash, right now. You're effectively speeding up your cash conversion cycle.
And a most common way to do this is through a process called factoring. This is what we're really going to dig into today. In a factoring deal, a company sells its accounts receivable to a special kind of financial firm called a factor. The factor then gives the company an immediate cash advance. Now here's the catch, and it's a big one. You don't get the full amount. The factor buys your receivables at a discount. That difference, well, that's their profit. It's their fee for giving you the cash today and for taking on the risk that your customers might not pay up.
All right, so we've got the what and the why of factoring. Now let's get into the how. How does this actually work step by step? Who's involved? And most importantly for us in this class, how do we record it properly in the books? We're going to deconstruct this whole process right now. So you see the two main players here, your company and the factoring company. Now, I really want to stress this next point because it's a place where students often get confused. This is not a loan. I'll say it again, not a loan. When you get a loan, you create a liability, a debt you have to pay back. Here, you are selling an asset. You're getting rid of it. The factoring company isn't lending you money, they are buying your customer IOUs. Their whole business is built on being really, really good at figuring out if your customers are going to pay. That's how they set their price and make their money.
Let's break it down into 3 simple steps. First, you legally hand over your invoices to the factor. Step 2, the best part, cash flows into your bank account. And step 3, this is our part as accountants, we have to record it properly. So think about the journal entry. What's happening? Well, your cash goes up, so we debit cash. Your accounts receivable is gone, right? You sold it. So that asset has to come off the books, which means we credit accounts receivable for the full amount. But wait, the numbers don't balance? That missing piece? That's your expense. We debit an expense account, usually called factoring fee expense. This is the matching principle in action, folks. We have to recognize the cost in the same period we get the benefit, the cash. See how it all works? This one transaction hits both the balance sheet and the income statement. Okay, but as we know, there's no such thing as a free lunch in finance. This convenience, this quick cash, it comes at a price. So let's put some real numbers to this. We're going to walk through a scenario to see exactly what that cost-benefit trade-off looks like in the real world.
Let's say your business, put yourself in the driver's seat for a minute, has $100,000 in accounts receivable. These are good customers. You know they'll eventually pay. The problem is, you're not going to see that cash for 30, 60, maybe even 90 days, and you need it now.
Now, let's say a huge order comes in. It's a real game changer, but to fill it, you need to buy a ton of new inventory, and you just don't have the cash on hand. Waiting 60 days for your customers to pay isn't an option, so you call up a factoring company. You transfer that entire $100,000 portfolio of receivables to them. In return, they give you a big chunk of cash right away. But, as we said, not the full 100 grand. That discount they take, that pays them for two things. One, the time value of money, giving you cash today that they could have invested elsewhere. And two, the big one, the risk that some of your customers just won't pay.
For example, let's just use a nice round number, a 5% factoring fee. Now you need to know, in the real world, this number is all over the place. It depends on how risky your customers are. Are they all reliable Fortune 500 companies, or are they brand new startups? The riskier your customers seem, the higher the fee is going to be. But for now, we'll stick with 5%. So 5% of $100,000, that's a $5,000 cost.
So the math here is pretty straightforward. The factor takes their $5 grand off the top, and bam, $95,000 hits your company's bank account instantly. Now you can buy that inventory, you can make payroll, you can seize that new opportunity. Your immediate cash flow problem solved. Now, this is an absolutely critical point for accounting purposes. That $5,000 fee is an expense, a financing expense to be precise. A very common mistake students make is to just reduce the amount they got for the receivable on their books. No, that is incorrect. You have to show it separately on the income statement as an expense. Why? The matching principle. You have to match the cost of getting that cash in the period you got it. So that $5,000 hits your net income, bringing it down. That right there is the explicitly measured price you paid for that quick cash. So this all leads to the big picture, the decision itself. Because your job as future managers and financial analysts isn't just to do the journal entries. Your job is to decide if this is a smart move in the first place. So we have to ask the question, when does it make sense to give up $5,000 in profit just to get $95,000 in cash right now?
Let's lay it all out, the good and the bad. On the plus side, the upside is huge. It can literally save a company from going under. And it's not just about survival, it's about growth. Let's go back to our example. If you can take that $95,000, buy inventory, and make a 20% return on it, well, paying a 5% fee to do that is a no-brainer. That's a fantastic business decision. That's all about opportunity cost. But the downside is real. It costs you profit, straight up. And this is important. If you were to calculate the effective annual interest rate on that fee, it's often way, way higher than a simple bank loan. If you can get a bank loan, that is.
Okay, I want to wrap up by highlighting a few common mistakes I see all the time, so you can avoid them. Please pay close attention here. First, and this is the biggest one from an accounting standpoint, is completely forgetting to record the factoring fee as an expense. If you do that, your net income is wrong. It's overstated, period. Second big mistake is a mental one, thinking of this cash as revenue. It is not revenue, it's cash from a financing activity. And third, from a decision-making standpoint, the biggest failure is not comparing your options. A 5% fee sounds like what? Good? Bad? You have no idea until you compare it to the cost of a bank loan or a line of credit. Doing that comparative analysis, that's what separates the amateur from the pro.
And so that leaves us with this final, fundamental strategic question. Is getting cash today worth having less profit tomorrow? And as you probably figured out by now, there's no single right answer. It's all about context. If the alternative is going bankrupt, then yeah, that 5% fee is the best money you'll ever spend. It's an investment in survival. But if you're just doing it because it's convenient, when a cheaper bank loan is available, well, that's just poor management of your company's resources. Being able to tell the difference between those two situations, that's the leap from just being a manager to being a true strategic leader. So really understanding how to handle accounts receivable, the mechanics, the accounting, and the strategy is a powerful tool to have in your financial decision-making toolkit.
Thank you.